Welcome back. You're still tuned into Power Breakfast. Well, the Paytm stock continues to remain under pressure on the back of RBI's crackdown on its banking business. CNBC-TV18 has now learned from sources that the regulator was forced to act after serious lapses in KYC norms that led to money laundering concerns. There are evidences of several related party transactions and false compliances. They were found to be submitted by the bank. Ritu Singh, she has been tracking the story very closely and is joining in with what she's picked up. Ritu, good morning.
Good morning, Sonal. From major irregularities in KYC processes, submission of false compliance reports and concerns about the group's commitment to transparency. Now, there have been some series of lapses by Paytm Payments Bank over the last 5 years, which culminated in RBI stringent action against Paytm Payments Bank. Now, we've been given to understand from sources that within a year of the bank starting operations, RBI had already started to find instances of non-compliance, which ranged from breach of day-end balances in customer accounts to serious KYC violations. In the later part of 2021, for instance, RBI found some major KYC anti-money laundering violations by the bank, and despite regularly engaging with them, the bank could not address these deficiencies and they continue to persist. These irregularities in KYC that RBI found exposed customers, depositors and wallet holders to some serious risk. They included the likes of absence of KYC for lakhs of customers, PAN validation failures in lakhs of accounts. Instances, there were examples of a single PAN card being linked to more than 1,000 customer accounts. The inspection also showed that the total value of transactions was often running into crores of rupees in some cases, which was far beyond the regulatory minimum, of KYC prepaid instruments, and that raised concerns about money laundering concerns as well. Now, we understand there was an unusually high number of dormant accounts which RBI found, which are prone to have been used as mule accounts. In fact, our sources said that roughly out of 35 crore wallets, about 31 crore were found to be inoperative. There were also concerns arising, from deficiencies in the KYC, which could have led to money laundering as well, lack of transaction monitoring as well. The second big concern was the fact that the bank did not maintain any arm's length distance in dealing with promoter group entities. Its financial and non-financial businesses were commingled with the promoter group companies, and that there was no operational segregation between the IT infrastructure of the bank and the promoter, and the compliances were also found to be false. So all of this put together led RBI to act the way it did.
Okay, all right. So those are some concerns that RBI had. Ritu, thank you so much for joining us. We'll keep coming back to you for more updates on this important story.